Hi everyone, welcome to my channel. In this video, I will be discussing top 10 overlooked tax breaks and deductions after the tax reform. So every now and then, I would like to go over commonly missed tax write-offs for self-employed individuals and businesses. So with that said, if you haven't already subscribed yet, please subscribe and make sure to give this video a thumbs up. Now, whether you struggle with your own tax return, hire a CPA, or put your trust in a software application, the more you know about what's deductible, the more you'll save on your taxes. Your tax return lists only a handful of deductions, so it is up to you to make sure you find and claim every one. Unfortunately, the IRS will never tell you about a tax deduction you did not take. It's entirely up to you. As they say, if you don't claim it, you don't get it. So you have to find these deductions yourself, because after all, it is very much like finding free money. Okay, let's dive in. Website. It is important for business owners to set up and maintain a functional website in order to build a successful business. While this could be costly, the cost of designing, setting up, and maintaining a website is tax deductible. However, it is important to distinguish between capital expenses and current expenses. Capital expenses are those that have a lasting benefit and are incurred for the initial design cost or development in the setup of a website. If these costs are significant, it may have to be amortized over 3 years. This would include hardware and the cost paid to the web developer. Current expense are those costs associated with the maintenance and functionality of your website. These costs include domain name registration, hosting fees, and cost of maintaining a website. Unlike capital expenses, current expenses are tax deductible in the year they are incurred. The cost of internet access is fully deductible if used only for business. If used partly for business, you prorate the cost and deduct only the business portion. Work clothes. Deductible only if unsuitable for streetwear or if it is a uniform. This includes costumes and protective gear. Clothing with your company's logo or advertising is fully deductible, even though the clothing may be suitable for streetwear. Cost of cleaning work clothes is also deductible. Personal products. Generally, expenses incurred to enhance your personal appearance, such as makeup, hair care, or skincare, are not deductible, even if the expenses are incurred solely to present a business image. However, people who are in the business of selling personal products, such as makeup, can deduct the cost of using those products on themselves because they are demonstrating or modeling the products. Prizes. Prizes and awards given to customers that generate sales or publicity for your business are deductible. There is an important difference between prizes and gifts. The deduction for business gifts is limited to $25 per recipient per year. Prizes and awards do not have that limit. For the IRS, the distinction is whether it is an incentive to generate sales, a prize, or a thank you after a sale, a gift, limited to $25. So I suggest you deduct the price as a prize, especially if the amount is not significant. The real problem here is that prizes are considered taxable income to the recipient. Few people know that when they win a brand new car in the popular game show The Price is Right, they will owe income tax on the retail value of the prize. And often they're pretty shocked when they find out, especially if they find out by getting an IRS form in the mail reporting the price, which you, the merchant, are required to prepare for any price that has a value of $600 or more. If the price is under $600, you do not have to file the 1099 form. The price is taxable to the recipient no matter what the amount, but at least you don't have to report anything to the IRS. Now, if you're giving prices, how you deduct them depends on what you're giving. You deduct merchandise the same way you deduct inventory. However, if you are providing a free service, there is no tax deduction because you cannot deduct the value of your own time. Awards. For employers, awards paid to employees are considered taxable wages subject to all payroll taxes. It does not matter if an award is money, gift cards, gift certificates, or goods. The awards are taxable. However, small token awards of merchandise, but not cash or gift cards or certificates, are not taxable to the employee. There is one exception to the employee award rule. The IRS recognizes something they call an Employee Achievement Award. Up to $400 per year in merchandise, but not cash or cash equivalents such as gift cards, can be given to employee tax-free as an Employee Achievement Award, and the employer gets a deduction. The maximum increases to $1,600 a year if you have an IRS-approved qualified plan. Employee Achievement Award are, for example, length of service, but not for things like top salesperson of the month. Employee Achievement Awards cannot be disguised compensation. Networking. Networking usually refers to interacting with people to promote your business. Networking expenses are deductible, although you want to be careful that the expenses are not considered entertainment, since entertainment expenses are not deductible. Owner's draw. Payments to owners are known as draw. It refers to drawing money out of your business. This is not an expense and therefore is not a tax deduction. The owner of an unincorporated business, such as sole proprietorship, partnership, or LLC, cannot get a tax-deductible salary or wage since you're not an employee of your business. The profit of your business, which is computed without regard to your draws, is considered your wage and is included on your personal income tax return. For corporations, if you own a corporation, the rules are very different. In short, you do not draw money. Any money you take out of a corporation in excess of your salary is also not a draw. It is a taxable dividend. Lobbying expenses. If you spend money to try to influence a federal or state legislator or a federal or state election, you can deduct up to $2,000, but only if the money is spent in-house, meaning you cannot hire an outside professional lobbyist. The $2,000 law applies only to state and federal legislation. On the other hand, political contributions are not deductible. The IRS makes a distinction between lobbying, which is trying to influence a legislator or legislation, and political contributions, which is donations to candidates or political parties. There is no $2,000 exception for political contributions. Bounce checks. Bounce checks are deductible. Not the ones you wrote, but the ones your deadbeat clients or customers bounce on you. You can deduct the amount of the check, assuming you recorded the check as income when you got the check. Any bank charges are also deductible. Reimbursements. For businesses reimbursing the business owners, your business can reimburse you for your out-of-pocket expenses, and the business gets a deduction. But the IRS requires you to have an accountable reimbursement plan, which is a written policy that the expenses are business-related and substantiated. That is, you have receipts. If you are a sole proprietor or the owner of a single-member LLC, you are exempt from this reimbursement rule. Any money you spend for your business is a business deduction, whether you spend it from your personal funds or from your business funds. There is no need to reimburse yourself. Self-employed individuals who get reimbursed by clients for out-of-pocket expenses include the reimbursements as part of total income and deduct the expenses as regular business expenses. Now, if an employer reimburses an employee for out-of-pocket business expenses, the employer is entitled to a tax deduction for the expenses, but only if you have an accountable reimbursement plan. If the employer's reimbursement exceeds the employee's actual expenses, the excess is considered wages and subject to payroll taxes.